My name is Vasil Mikhov. I'm a professor of finance at the Neeley School of Business. I'm also one of the Ralph Lowe Energy Institute faculty fellows. And the next topic is appropriately titled Financing the Future of Energy. Show me the money. Not very subtle. We are not very subtle, right? This is an important topic, and it is very much in the spirit of how in the Institute we tackle energy problems through a multidisciplinary approach, as opposed to strictly from a technological standpoint or a political standpoint. We have already heard from the panel discussions this morning about some of the challenges, for example, that legacy industries have in attracting capital. We also heard from the very first panel that capital markets and private capital is willing to jump into new endeavors if properly incentivized. And ultimately, an energy strategy that would work would have to be good for society, and that includes business. And herein lie some of the tensions that I expect the panelists to discuss. Let me introduce very briefly the moderator, Dr. Tom Seng. We've had him only for a year, but he's been a real difference maker. He is an assistant professor of energy in the Energy Institute, and also I have the pleasure to have him as a colleague in the finance department, and he brings a wealth of experience both from academia and industry. So take it away.
Thank you very much, Vasil. I appreciate that introduction. And I hope you all enjoyed the luncheon. I hope you had a lot of caffeine, because we know what happens after lunchtime. I'm honored to be hosting this. It's my first conference here, but I'm joined by Michael Jamieson with Citi, Betty Jin with Credit Suisse, and then Dean Foreman, who is the former chief economist for the American Petroleum Institute. So the subject is funding. I thought we might categorically by energy source, so maybe let's talk about oil and gas and how we see future funding there. In other words, if we go back 2 years ago, we finally crested $60, then $70, and it looked like, you know, go baby go, drill baby drill, except we know the investors pulled the reins in and said, wait a minute, time out. All right, we want to see accumulation of cash, free cash flow, and then with that, we'd like to see you pay down debt, pay out dividends, and do share buybacks. And that's been fairly consistent. I mean, pre-COVID, we were up to 13 million barrels a day of oil production, and now we've, you know, maybe a high of 12.3 to 12.5. So my question for each of you is, do we see that? Is that going to be the MO moving forward, number one? And number two, how do we increase production if that seems to be kind of the funding that's going to happen in the future? Dean?
Well, thanks for having me. It's great to be back here. From last year's session, which was really engaging and fascinating, I think we should pick up with a global picture and some frame to go with these pictures about U.S. production. If we look at the International Energy Agency and what they've been saying about financing energy for the future, roughly, and take the pandemic out of it, but since 2017, each year has ranged between about $2 and $2.5 trillion worth of global energy investment. Now, of that, we can split it out into quarters, and we can say renewables and nuclear about a quarter, energy efficiency and other initiatives about a quarter, electrification, grid upgrades, EV infrastructure, low carbon stuff about a quarter, and then oil, gas, and coal. Out of that $2 to $2.5 trillion, only $400 billion is oil and gas. And by the way, last year by IEA estimates, and this is consistent with our tracking for the US-based publicly listed companies in the US, it's still from last year and into the first quarter of this year down 15 to 20% from where it was in 2019, pre-pandemic. So you don't get something for nothing here. And when we start looking at who has been investing, it's been the national oil companies, actually, that have been picking up their investment, not so much the global integrated companies or the independents in the US, for all the reasons that we've discussed. And this is important, right? Because people complain then that OPEC Plus has market power, but yet this has kind of begotten its own problem. Now, let's take that apart because we've addressed two aspects. We've talked about the energy mix, the investment mix, and then the structure of the industry. Let's add geography on top of this. And this has come out through the day. If we don't have a focus of energy investment on emerging markets, solving those problems, effectively just displacing demand in developed economies provides a subsidy to use more of the fossil fuels or traditional fuels in the emerging markets. So this has to be kind of global thinking of how to tie the system together. A fourth dimension we must consider is time, or the risk-time consistency of energy policies. So in plain English, how do you get people to invest in things that have to last 20 or 30 years or more when you're saying you want them out of business within a decade or so? And this is a real issue. So how do you step in? And we can talk about government funding, and I want to digress on this for a second because it really does play into the US industry. The European majors are largely content and acknowledging that public support mechanisms, government funding, are going to play an increasing role in making this go in the future. On the US side, most American companies have trouble with that. If it doesn't economically stand on its own, it's the old Economist joke, right? I may be losing money, but I'll make it up on volume. And that just doesn't float over the long run. So these are serious issues. And if we zoom out now, assuming the US government is funding this to the US macro situation, quick quiz based on news items from December till the last couple of weeks. If we take last year, in December, at the end of the year, what was the Congressional Budget Office's projection for the US federal budget deficit? Anybody? Okay, no hands. It was a little over $900 billion. That was the estimate. A couple of weeks ago, revised the estimate. What's the actual?
Over $1 trillion.
1.4 trillion. That is a 50% forecast error within 1 quarter. Now, we've talked about the Inflation Reduction Act and what it will do to incentivize investment, right? There's a Goldman Sachs report out earlier this week saying that it'll incentivize over $3 trillion worth of clean energy investment. Well, that thing was scored by CBO as reducing deficits over 10 years by over $230 billion. If you account for the fact that you have to take on federal debt to do it, it still magically says that there's a savings of $61 billion. But by the way, those subsidies and those things that are codified don't end after 10 years. They keep going in perpetuity under the Act. So it's not actually scored correctly. We're taking on consistently more debt, and we've got a problem from an untethered public finance system that's not fiscally responsible at this point. So where does that all end us? For public support mechanisms to be credible in the long run, you have to believe they're going to be there, and the pendulum politically, if it swings back, doesn't erase those. Otherwise, people in the markets aren't going to form on that basis either. Now, the next point we talked about was multilateral investment banks and wanting to invest or investigate their role. No surprise, World Bank, IMF, they've largely scaled back completely from coal, almost entirely from oil, and they're only doing selected gas projects. So for traditional fuels, very little multilateral investment funding. If you're sitting in Africa and you have the resources and all the things that multiple speakers have talked about today about wanting to develop and bring people out of energy poverty, guess what? That takes capital, and that's not happening right now. So now let's bring it back home and talk about the news of the day. If we're looking out the window the last couple of weeks, we've had an emerging or budding banking crisis, right? Silicon Valley Bank. This week it's First Republic Bank, Signature Bank. Silicon Valley Bank is really interesting because despite some of these being somewhat idiosyncratic, it's an object lesson in when you plow a lot of debt and investment and lending into companies that don't make money, you can't make it up on volume, and that's where they are. So that's the big picture. It's a lot of investment and even more investment that's needed to get back to 2019 levels. We've talked about the geography, the timing, the energy mix, and the structure of the industry and how those contribute. So I'll wrap there. Those are the things that are on my mind for this.
Great. Thank you, Dean. Betty, you have that ESG background, so from that kind of perspective, how do you see investing in energy?
Great. And I will go back to oil and gas. So I actually have pretty interesting background. I covered the E&Ps for over a decade, so buy sell rating on the sell side. And then 3 years ago, I took on the role of US ESG research, when early on, no one really defined what ESG research was. And I tend to gravitate towards energy transition, climate-related work. The more I look at ESG, it's, so I have lens on both, and it gives me this perspective that the oil and gas industry is in a really difficult phase, and it faces a lot of challenge from the ESG and sustainability lens. There was a question earlier in the day that asked about why sustainability, drivers to avoid oil and gas investment. So I want to set a bit of a scene on what's actually going on the asset manager side. So what's happening is that you have asset managers, asset owners, banks, insurers, all coming together, committing to a net zero target by 2050. What that requires them to do is set interim targets by 2025, 2030, in order for them to get to net zero by 2050. For example, for an asset manager, they have to finance portfolio emissions. So the emissions related to their investment, their portfolio, needs to go down, say by 50% by 2030 and net zero by 2050. For banks, they have to see their lending portfolios, and I'm sure Michael will be talking about that too, in that the lending portfolio, who they want to do business with, they're actually setting specific targets for oil and gas industry, for power industry, to cut emissions for power, say 70% by 2030. And then for oil and gas, 20 to 30% by 2030. And those are the targets and pressure that the financial institutions are putting on each other and putting on themselves. It is very, very difficult for them to do that, and it's creating a lot of tension. It is creating tension within the asset managers because the sustainability teams are saying, we have set these targets, now we have to achieve them. And the investment professionals who are actually making these investments are finding it difficult when the real world, clearly from everything we're talking about, we're not achieving these type of goals. So you have these targets that are being set, but we're far from these targets, and we have not seen those targets roll back yet. And that creates, and then think about how would these targets get rolled back? Like, would BlackRock come out and actually say, we are tempering the emission targets that we have set? Or State Street or Vanguard? It's just very difficult for them to roll back these targets, which is why it's creating this issue of pressure on financing for the oil and gas industry. Now, what I would say is that I have not met a single investor that are willing to give up return to do all this. They want to, everyone wants to make money. In 2020, so last year, when energy really outperformed, is when we start seeing questions from investors saying, can we own energy? Oh, no, sorry. Can we get energy exposure without owning energy? And these are investors who are, because of this, because of the targets that they have set, they have tend to avoid carbon-intensive industries, and that's what had outperformed. And as soon as performance becomes an issue, they start questioning, wait, is this underlying narrative still sound? And it worked historically. So the reason it had worked for 10 years before that, and I was part of that ecosystem, was that energy investments did not work. It was underperforming because of returns. Like E&Ps were losing money or was not doing what it should be doing because of a variety of issues, but it was not entirely because of climate and ESG. Like investors were losing money when they were in these investments. And this is why we're all now investors for the oil and gas industry is focusing on shareholder returns. Like after losing money for 10 years, after seeing a lot of bankruptcies and uncertainty in the energy industry, they want shareholder returns. And until the industry can really deliver that and to prove that that's what they're focusing on, investor will keep on putting that pressure and telling them that we want free cash flow rather than you putting that money on the ground. So we're in a very interesting time in this area, but there's many drivers that are behind this. That's well beyond just ESG.
Thanks, Betty. Michael, before you go, sir, props on your socks.
Yeah, absolutely. Oh, look, I would maybe just reiterate something that was said there, and that is the energy industry in some ways created a self-inflicted wound over the course of the last decade, and that is not returning capital to shareholders, not returning, having returns on the capital that was ultimately deployed. And so when the whole ESG movement came into play, it was very easy for investors to say, this is dirty, I can be clean, I don't have to invest in here, in particular because I'm not making any money around the sector. And so what effectively that did was drive investors out of the investment process for traditional energy sources. I think that's best illustrated by energy's representation in the S&P 500. Historically, energy had been roughly 8 to 15% of the S&P 500 value. Over the last couple of years, that dropped to 2-3%. And it was just a wholesale purging of investors from the industry overall. Obviously knocked down valuations, the participation to raise capital around projects became very challenging for companies in the public context, but also in the private context, with Fink coming out and talking about how he's not going to do any more traditional fossil fuel investments, since been retracted, by the way. But it really put a strain on the ability for these companies to ultimately fund their businesses. So what happened? They went inward and looked at the cash flow that was being generated from their businesses, ratcheted down capital expenditures, and effectively are now living within their own means. And it's across the entirety of the energy spectrum, from upstream, midstream, and downstream. The capital that people were applying back into the ground has been reduced dramatically. And so now the majority of these companies, given where commodity prices have been, enjoy very strong balance sheets, have very strong cash flow profiles, and really can live within their means. But what has happened over the course of that period of time, there's been an underinvestment in resource development. And so when you think about in the future, what does that ultimately mean and what will that transpire towards, is likely higher commodity prices. Because we have an underinvestment in the overall industry. And as investors now start to look at where can they make money, where can they get returns for their LPs, either in the public context or the private context, people are starting to look back towards the traditional energy investments. And so what we have seen is a lot of, over the past 3 years ago, a lot of focus on trying to find the energy transition, energy addition opportunity set. And what ultimately transpired through all that, it was really, really hard to make money. And the ability to generate returns in renewable power, in new technology, hasn't ultimately been sustained. It also takes a tremendous amount of capital, so you're making big bets for lower returning projects, and in some cases, non-returning projects. And it's pushed people away from investing along those avenues and back into the traditional sources. That's played out on the banks as well. I run a group we call NERSET, Natural Resource Clean Energy Transition. What that means is I have the power, energy, chemical, and our clean energy transition businesses underneath us. So I have a perspective of where capital's flowing. And what we saw 3 years ago from a balance sheet perspective, where the banks were trying to push their loan dollars, they were trying to take away from the fossil fuels industry and push it towards the energy transition, energy addition part of the opportunity set. But what we have since realized over the course of the last few years is, one, there's not a lot of those opportunities necessarily available, but two, the traditional energy companies, those companies that have the engineers, the commercial relationships, the balance sheet, the financeability, and ultimately the ability to penetrate various markets, are going to ultimately be the agents of change in terms of where energy transition may be going. And they are going to be the ones that ultimately facilitate the new technologies and the growth and the build out of the infrastructure that's ultimately needed to achieve where I think people are ultimately trying to go.
Great, thanks. So let's consider a scenario. In other words, we know that with the Infrastructure Act and of course the Inflation Reduction Act, right? This is government subsidy, and let's call it what it is. It's deficit spending. Let's just say that ran out in a couple of years, funding for all these projects. What would you see being sort of the dominant investment? In other words, what sources of energy would then be the focus and would investors want to turn towards? In other words, we've got things like hydro. Carbon capture is kind of an offset to energy. It helps to clean up the industry. But we have these other things out there that are being subsidized, wind and solar. What if those subsidies expired in 2 years' time? What would investors gravitate to as energy investments?
I think the answer may be imports, actually. But when we're talking about the debate that led up to the Inflation Reduction Act, a lot of the contention was that if we didn't have those continued wind and solar subsidies, that we wouldn't invest.
Right.
Despite the fact that from Lazard, the levelized cost is a lot lower. And if you look at Lazard's latest edition, by the way, they've added fitting costs to represent how it fits with the network itself. And the costs are actually a lot higher. And when you talk to RTOs about fitting these things into the system, it's the same. So the electrification part will continue to grow. Don't get me wrong, regardless. And I think that it's probably fair to call it an energy evolution rather than a transition.
Sure.
But oil and gas, the issue that we've really got from a growing shale perspective is infrastructure limitations. The capital constraints are a real part of it. The human workforce issues that we talked about, steel tariffs, cost escalation, there are a lot of things that contribute.
Sure.
But without enabling policy, it's an issue. So Texas, by the way, record production recently. It's back. But go across the border to New Mexico, not so much, at least not from an oil perspective. Colorado's taking a powder. North Dakota and Wyoming, not back to pre-pandemic levels in terms of drilling. This is a problem. And year on year, by EIA estimates, productivity in the field is down 20% year on year in their estimates across the oil patch. So again, you don't get something for nothing. It's going to take more organic activity to get production back. We never got to 12.5, by the way. The highest we've seen on a weekly basis is 12.3.
Yeah.
We're still down the better part of 1 million barrels per day in terms of crude production from where we are, partially offset by more natural gas liquids.
Right.
But it's not enough. What we took out of the SPR last year, the Strategic Petroleum Reserve drawdowns, 1 million barrels per day over the last 6 months. We've continued to sell it into this year. Our consumption compared to 1983 is 30% higher, more than it was. But we've got the lowest reserves in 40 years now.
All right, thanks, Dean. Betty?
Tom, I think the short answer to your question is if the Inflation Reduction Act and tax credits are not there, it's not going to happen. Now, the wind and solar did not require credits. It was more of a regulatory transmission issues, but carbon capture industry without $85, not going to happen. But now, this is where I think my sustainability hat really hits where, the IRA and American leadership on climate is really the best thing that could happen to move the world forward. In that, until the IRA came along, the train has already left the station. In the world, nations have come together at COP26, 27, committing to net zero goals. Europe has pledged written climate neutrality into law by 2050. Canada has done the same. And all the nations have come together to set these goals. Now, there's no plan outside of the scenario analysis of how we're going to get there. And until now, the narrative has been driven by Europe. And Europe is a penalty avoidance system. And the Europe narrative is about let's just use less, more energy efficiency, and then just tax people if you emit. And that hasn't been that effective. It is effective. It's the only thing that's most mature from the regulatory standpoint, but it's not that effective to really drive significant level investment. IRA, on the other hand, is driving substantial investment that's already happened in the first 9 months of that bill. We are seeing substantial investment across the climate areas, and instead we're now worried about execution, human capital, and ability to actually execute on that. And we do need the government to subsidize some of that early cost so that things can get cheaper over time if we are going to achieve these goals. And I think that longer term targets and ambitions have left the station, and there's a lot of things that U.S. We have the competitive advantage having the industry that we already do today. We can leverage existing infrastructure, existing talent, and really become the leader in clean energy as well as traditional energy. So the U.S. narrative is about what we have today plus more, and we can add more and lead on innovation. And I think IRA and the bipartisan infrastructure bill does help to drive a lot of that innovation that can make a difference in 2030 and beyond.
Eddie, thanks.
There's no doubt that it's driving behavior, and the IRA, without the IRA, a lot of these projects would just not be economic, and there's only so much capital out there to invest in non-economic projects. What I'm concerned about is the unintended consequences of driving down a track and not exactly knowing where we're going. And I think we saw it with a lot of the financial institutions putting policies in place about carbon reduction and having no idea on how to achieve those reductions. So now they have these stated goals out in the marketplace trying to figure out, well, how am I going to ultimately get there? The reality of it is the industry is going to largely get there for the financial institutions, because the way we look at it is we look at what is the carbon emission in 2019 and what will it be in 2030, and companies are in fact reducing carbon emissions. I was just up in Calgary, Canada, the earlier part of this week, and we were talking about how they're putting solar panels on their compression stations to drive their energy costs down. And then ultimately have a bullet point that they can say that they're greening their field. That is now made more economic by the subsidies that are ultimately being put in place, but that stuff was ultimately already happening. But the concern is we're trying to achieve a certain reduction, and to your point, is there going to be a point in the future where the financial institutions say, I need to cut my lending book to the traditional energy companies by 30%, because I need to achieve my goal that I set 10 years ago and had no idea to get to, and I haven't gotten there, but now I need to show some improvement? Possibly, right? The private equity firms, again, Fink, said that he was no longer going to do energy investments, and now is absolutely doing energy investments because he found out that he couldn't make returns on the non-traditional energy. But is there a point in the future that they start to pull back capital? And that's where things get a little bit scary when you set out policy and not exactly know how to get from point A to point B, but it is ultimately driving behavior. And I do think that there will be projects and things that otherwise would not have been able to attract capital, that attracts capital because there's government intervention in it.
Great, thanks. Ken Wagner's right here. You all heard him this morning. We had a chance to speak last night. One of the things he pointed out, which I think is very relevant too, is, and I had not thought about it, when you basically put that much money out into the marketplace in terms of incentives, everybody's scrambling, and the cost to accomplish these things also goes up as a result. I think we have time. We were running a little bit late, but we do have time for questions. If you guys have any questions, we'll have people bring you.
Should I come up or use your microphone?
Well, we were going to write them down.
Let me borrow one of these.
Yeah, there we go. Thank you, Ann.
Thank you all. Since Michael just talked about incentives, and Betty touched upon that too, if you were to design from a public policy standpoint, and that includes states as well, would you rather see incentives on the supply side or the demand side?
need both. We do need both. I think the issue is, well, one, I sometimes in my seat, I refrain from providing specific policy conversations, but what I can observe from what's being out there today is that we are lacking demand-side incentives. So it's always a chicken and egg thing. Like if we want to accelerate hydrogen, we need to make sure that clean hydrogen getting produced gets used by something. And right now, that industry is very nascent. And what I consistently hear is that hydrogen projects cannot FID without signing long-term offtake agreement. And that offtake agreement is difficult to sign when you don't know about certainty of supply and how much it's going to cost. So it's a chicken and egg. But the policies currently enabled by the IRA and the bipartisan bill is really on the supply side. It is helping to drive the supply cheaper, but demand is a question mark. So Canada, I actually think they strike a pretty good balance based on what they have proposed so far, that they're doing both. So they're helping the supply and doing contract for differences, which is the government helped to bridge the gap to reduce the green premium to accelerate. And the hope is that eventually supply cost is going to come down, demand will start pick up, and that's how they facilitate new markets.
I was going to add on to that and just say, from a demand perspective, it is sort of the poor stepchild in the way a lot of this gets modeled, right? More as the attention is on the supply side. That's where you see concrete things that get touched. But the carrot versus the stick on the demand side is controversial. And when you start looking at the carrot of making things cheaper for people to consume it, it's not scalable to an entire population, right? So then the carbon tax, carbon market, and if we're not focused on least cost solutions, we're picking losers and winners among technologies that aren't necessarily least cost, and these things are path dependent. So we need to find a way to incentivize markets to kick in to solve these issues. And in the absence of any kind of regional, global, at least US, price on carbon, this is a serious issue. So yeah, I think the demand side needs more work, but that's where it should go.
Great. Sir.
There is another aspect of show me the money, and this lies at the end of the road of this evolution or transition. A lot of national governments depend on the taxation of the fuels for their budgets. In Japan, it's about 13.5%. In Europe, in Germany, it's about 5%. In Great Britain, it's 10%. In my own country, Greece, 11% of the revenue of the government comes from carbon taxes and from the excise taxes on fuels. That has to be replaced in all of these countries. And what I'm afraid is that what will be taxed at that time will be the kilowatt hour that comes from wind and solar, and then we're going to be in a big problem.
Well, going back to the macro issue we talked about, exactly that. You've got deficits around the world that need to be covered, right? And the IMF, by the way, and the IMF World Bank annual meetings were 2 weeks ago in Washington, D.C., yet they are bracing for the next wave of bailouts. Could be, start with Argentina, Ghana, Sri Lanka, go on down the line. You've got half a dozen African nations on that watch list. So finding ways, taxing fossil fuels, taxing things that are viewed as a sin tax, that will be a go-to source for pay-fors for that kind of thing to try to close that gap. How that gets managed vis-a-vis affordability is a really contentious issue, and it's not obvious how it'll play out.
We've got time for one more. I'm not sure, sir. Yes. Sorry? Oh, okay. I'm sorry. Thank you. Great. Thank you.
One of the things that is puzzling me, I'm hoping that you'll be able to shed. One of the things that puzzles me, and I'm hoping that our panelists will be able to shed some light on it, is partial explanation for why the price of oil and gas went so high. Russian invasion of Ukraine, that's one. But the second one was that not enough investment in fossil fuels. All the things that we talked about, the terrific attraction of renewables drawing the money to them, deprive fossil fuel of necessary investment, so their availability went down and prices went up. All the things that you all talk about is that we are going back. Europeans are making a correction or a U-turn in some ways to fossil fuel, realizing that the projection of immediate ability of renewables to provide the type of energy needed for the consumer is not there yet. But at the same time, I'm reading many things that in the short term, we're going to see higher oil and gas prices despite all the investment. How would you explain that puzzle?
Well, there's not enough investment in terms of last year and so far this year. The official projections show that world markets are short, meaning that demand's been outstripping supply for both oil and natural gas. And the tailwind to that has been Russia's war in Ukraine. Take that separately, though, and start to look at where it can go. There's generally been an underassessment or not enough appreciation of the natural decline in oil and gas and what it means just to tread water and continue to produce at current levels. So when we're talking $400 billion in 2022 by IEA estimates, normally that should be 5, 6. It should be a lot more just to tread water. When I was at ExxonMobil's corporate planning group from 2002 to 2008, I was the only economist in the group. The general belief before the shale revolution was that you could not sustain, the world could not sustain enough production to meet demand if it reached 100 million barrels per day. And lo and behold, in 2019 and now, that's where we are, right? Projected to grow to record levels again next year, getting more bullish along with the economy by the official estimates. So the shale revolution has changed that, but the shale revolution is also under siege. It's not growing, it's not as resilient, and despite the official projections that say it could get back there next year, the investment behavior, the productivity behavior, the lack of drilled but uncompleted wells, the workforce constraints, the steel tariffs, and frankly, an administration that honestly, from a Secretary Granholm perspective, really does want higher prices. They just want to be blamed for it because it incentivizes the energy transition in their view. So these are the issues, and it really is serious of how you get there, but that's why the prices are where they are. And think about this. This is considered the precipice of a global recession, right? On a market exchange rate basis, maybe a little under 2% growth this year is the consensus view. $80 oil. $80 oil in a recession. This is the bottom point. China recovering later this year. You start looking at technical indicators, supply-demand indicators, any econometric estimate you can get. Take the OPEC plus estimates on top of it. Understand the market share game that's going with that. It's pretty bullish. It's a bullet, and that's why I would be very bullish on both oil and gas. The only thing that's been a savior for natural gas from a consumer's perspective has been an unseasonably warm winter. So you don't have to backfill European stocks this year as much as you normally would, but this is exceptional. Even a normal winter next year gets us back into real crunch if we don't have a resolution with Russia that's not exactly on the map right now.
Sure. Good, Michael.
Gas will continue to have some tailwinds to it from perspective of LNG development in the United States and obviously gas needing to get to Europe and other parts of the world that are in short supply. Right now, gas is obviously price is not all that great, but longer term, you can really see that gas is going to be a global commodity and there's going to be demands coming from places that maybe hadn't anticipated before, in particular Europe, given the constraints that ultimately played out there. So to the point, there should be longer term and the middle term good price performance for the industry itself, which creates more returns. But the lack of capital that has ultimately gone into the sector has really put constraints on the ability to generate supply.
And let's add to that, though, that European consumers or utilities at this point are not willing to sign long-term LNG contracts. That has not shifted. They just want the gas for now as a bridge, and that's not going to bring the investment that's needed.
Well, that goes back to the financeability of projects, and when you think about new technologies or additional energy sources, you need the supply and demand contracts to get the project finance in place, to get the private equity in place, to get the term loans in place, whatever the case may be. And it's very, very difficult to put all that together in size. All these things are big, big billion-dollar, plus type capital commitments. Very, very difficult to get it all pulled together.
I'll just add an ESG angle here, where the debate for the oil and gas industry, like the Scope 3 emissions from combustion of fuels, oil and gas industry is, if you apply the Scope 3 concept, oil and gas industry is effectively responsible for 75% of greenhouse gas emissions. For them to reduce their Scope 3 emissions, the only way to do that is to reduce oil and gas production. So the debate, in some ways, is how much to decline their production base versus even just to stay flat, not even talking about growing. And you are seeing that with the European majors that are declining production, because that's how they're that's what they have to do in order to meet these type of goals. And so this is where the market is signaling, we don't want growth, right? We want return, we want cash flow. So in the industry that has, I haven't looked at E&P valuation for a while, but it's been multiple compressing for a while. They're trading at a fairly low multiple. Like, companies are not being rewarded, so there's no scarcity value in this space. So why should they? Like, why should they be investing from the management's perspective? They're being told to just generate cash flow. And interestingly, just at CERAWeek a couple weeks ago, what really surprised me too is that same message is happening in the natural resources industry and the metals and mining side too. They are also trading at a very low multiple, despite what we're saying about demand for copper or lithium and nickel. Like, they're not being incentivized to invest, so they're not. And until we start bringing the natural resources industry as part of the solution, and they're absolutely part of the solution. Like, they have the money, they have the capabilities. Until that happens, it's really hard to get the industry to be involved and really invest in their own assets.
Yeah, I had a question that kind of related to that. You teed it up beautifully, so thank you for that, Betty. Your experience covering kind of U.S. E&Ps, and then Michael, you made some comments, I believe, at the beginning about kind of incumbent energy players taking a bit of leadership in this. Do you think the U.S. independents should sort of do more along the energy transition, lower carbon investments, like Devon, as an example, just did a small deal with an advanced geothermal company? When you look at the cost recovery mechanisms, like, it's pretty exciting. So that's a specific example, but just general question of, would you look for the U.S. independents to start to change their business models a little bit because of the IRA support?
So it's interesting, because I've been talking to some energy investors, or traditional energy investors, and asking them how much they care about all the energy transition conversations that the companies are having. There are some leaders in the E&P space, like Denbury or CRC on the carbon capture side, because they actually have competitive advantage, also Occidental Petroleum. But interestingly, from the investor's perspective, now it's a separate issue, because they are looking at 2-3 year out. They're not looking at 5-10 year out. And then the answer is no, we don't want them to do that, because it's a drag on cash flow. Right, and right now these assets are not generating visible returns with visible cash flow. So instead, it's spending money, and having direct air capture for Oxy is considered a drag on their operations. So, and in some way, that's just where the mentality sort of need to change. If we don't have these big companies taking a bigger leadership step in driving forward the innovation and start cutting down cost and be part of the future, like, who's going to step into that role? But at the same time, the companies are getting messaging from the market saying we don't want you to do that. So I think it's really nuanced for the individual companies to play to their strength and then have the conviction that they can make a difference and have a competitive advantage in what they do. But there's no need to jump into something just because they have to, because the return is not necessarily there.
Yeah, I think you're going to see more of it around the adjacency opportunities of existing companies. So if a company has a pipeline that is idle, and can you put a different product through it? We're seeing the refiners get into renewable diesels. The aviation, businesses are looking for renewable aviation gas, and so the refiners are putting, that into play. And oh, by the way, the government's paying them, a nice credit to do that, so there is actually a positive return associated with that. Well, I think exactly to your point is I don't think investors want to see companies jump out and do something that is not associated with the current business that they currently operate. And really where we're seeing the activity for existing companies is using their businesses in a different way to stimulate a different result. And we're seeing that actually work in a very positive way. I think Barry Davis was here this morning, the company he started, InLink. They had some pipe that is in the industrial complex of Louisiana and really started to facilitate a carbon capture sequestration business using idle pipe into areas where there is CO2 emission. Smart. They also get some credits for that, so even better economics, but that economic opportunity, again, partly stimulated by IRA and kind of government intervention, that is where I think you're going to see a lot of the change in the movement in terms of technologies and how traditional energy companies are going to play. From time to time, you'll see a company think about going into some battery technology. The carbon capture that Oxy's doing doesn't necessarily fit with their core business, and I think that'll ultimately play out in terms of valuations and how investors view those returns. But you are seeing real money being spent around adjacency opportunities.
I'd add the $10 million investment that Devon has made. It's exciting in a longer term perspective and it shows some forward thinking, but it's going to take 10, 20, 30 years if that's going to be a transition of the business. So it really is just kind of venture capital, almost seed money to make that happen. What is more existential for all the independents is something like the methane fee right now. So that can be dramatic. If you look at a Devon, and I think they've done things very right actually, it's M&A, it's aggregation, it's a focus on process improvement, getting costs down, and improving the recovery factors. Even just a couple of % improvement in the recovery factors on oil or gas wells makes a tremendous difference. And this is why, as we've gone and think how many naysayers for the shale revolution have said, no, you're going to run out of sweet spots, this is going to end. But yet, here we are plateauing, right? And we have the potential, at least technically, to continue to grow it with enabling policies and infrastructure because the technological improvement has basically, despite lesser rocks over time, if you look at the initial production rates and the type curves for various wells, since 2018, they've basically held pat. It's remarkable. So independents, they do have to have a longer term plan, but being able to add reserves, grow reserves, again, treading water and working against that current coming with all these headwinds is a real challenge for them.
Great. Okay. Yeah. Michael, Betty, Dean, thanks very much for your thoughts and your opinions today. We appreciate you.